Hey guys, welcome to another Ultimate Edge webinar series with Bay Equity Home Loans. And this time I'm one of my perennial favorites, Tom Howell. Hi, Tom. How are you doing this morning? I guess
I'm
this
great. How
afternoon.
are you?
I'm well. Little background, Tom and I have known each other for a number of years. Tom is an enrolled agent, which means he knows taxes better than most people you know. And he's also a real estate investor, and he knows real estate better than most people you know. And you put those two together, and he's very fun to listen to kind of every time, aren't you, Tom? Um,
I like to be
Tom and I
creative. Yes.
co-host a real estate investment group in North Everett. It's part of the REAPS organization of Seattle, along with another mortgage person there. And you could join us anytime. I just want to let you know, if you want any information out, reach out to Tom or myself. I saw this presentation Tom gave at that particular group all of about 2 weeks ago and said, Tom, we got to get you on the webinar. And so here we are. Thanks, Tom, for joining us today.
Well, thank you.
With that introduction, anything else you want to add, or you can pop into your presentation whenever you're ready. And guys, if you have questions, those who are in the audience, just put them into the chat box. And I'll pause now and then maybe and ask Tom a question as we go through. And at the end, you'll also have the opportunity to ask questions as well. All right, Tom, it's all yours.
Yeah, one thing I would say is our REAPS meeting in Everett is also available online by Zoom.
Oh, that's correct.
The only meeting that's available by Zoom consistently. So people from anywhere could join us.
Yeah, we did get people from all over the place, as a matter of fact. That's a good point. Thanks, Tom.
So very good. Why real estate beats Wall Street? I think a lot of people, particularly those who are already in the real estate business, kind of innately understand this. But I can tell you that I meet with a lot of clients who always tell me what my broker says this and my broker says that. And I would like to show you the difference between what a traditional real estate investment compares to a typical Wall Street investment, and why over time that doubling effect of your wealth time and time again can make a big difference over 10, 20, 30 years. So first thing I want to start with is a couple of quotes. Here we go. There's a lot of key people in the past who have said a lot of very wise things. Franklin Roosevelt said, real estate cannot be lost or stolen, nor can it be carried away. Purchased right, it's the safest investment in the world. Mark Twain always said, buy land, they're not making it anymore. And this one I really like. Andrew Carnegie said 90% of all millionaires become so through owning real estate. Real estate's made more money for more people than anything else in the world combined. And everybody seems to think that real estate is risky, it's too much work, it's not right. But there are so many ways to be involved in real estate. So I want to go through some definitions about how I'm going to define what we're doing here. Real estate investing is holding assets for the future cash flows and appreciation. This does not include wholesaling, flipping, rehabbing, nor brokerage. Those are all businesses in which you're pretty much trading hours for dollars and running a business. That in itself is not investing as I define it. And when I compare it to Wall Street investing, we're not day trading, we're not swing trading, we're not doing short-term Forex or crypto. We're not trying to time the market and be in and out, and that's work. You got to do a lot of research every day to be able to keep up on that. So,
and can I leverage off what this slide says, Tom, just a moment?
Yeah, sure.
The great definitions, great separating out real estate, wholesaling, flipping, and brokerage. But what's one cool thing about real estate, guys, is you can integrate wholesaling, flipping, and those activities into buying real estate and holding it for long term. You can do both activities with real estate at the same time, whatever kind of fits the need for you at that time.
That's true. And it's easier to be involved in as an active investor if you are also making a living doing these other things.
Yeah.
So I'm not trying to exclude those. I'm just, as we do the math here, we're not going to be making $100,000 in 90 days on a flip. So my math is about the long-term hold of the asset. So I want to go through some benefits of the various assets as soon as I figure out how to make my slide change. Okay. There we go. When we talk about the benefits of real estate, I think we all know this. You get cash flow from the tenants that comes in, so you have rent coming in. There's appreciation that you get over time as it goes up in value. The nice thing about real estate is we have the ability to apply leverage. Leverage is really the key to the big returns in real estate. There's also significant tax benefits, and we have some very, very aggressive upfront benefits that can get us back a significant portion of our cash investment in the very first year. And over time, our tenants are making the payments to us and we're making payments to the bank. And that is paying down our principal over time. So we have a little bit more equity after every month. With Wall Street, the asset benefits, you can get cash flow from dividends and you can get appreciation over time. However, most stocks that pay good dividends don't appreciate well, and most stocks that appreciate well don't have a lot of dividends. It's very hard to find a stock that's going to give us the best of both of those worlds, whereas real estate certainly has so many more benefits.
So Tom, can I ask a question right now that kind of pops into my mind and probably some people in the audience?
Sure.
With real estate, do you find that you typically can find real estate that appreciates over time and gets good cash flow? Or if you have good cash flow, you're in real estate that doesn't appreciate over time, or are the two separate typically?
Well, I don't know that they're separate. There are properties everywhere that have rental income and have appreciation. If you look at somewhere like Seattle, we have pretty strong appreciation, but the price of housing is so high that our cash flow can be pretty minor after using leverage.
Yeah,
If you go to typically Midwest cities, you can get much better cash flow because the price of housing is so much lower. So you get a greater cash flow, but you may not see the super appreciation that we would have in Seattle.
right.
But we do get both. It's unless you're buying land, that doesn't have a cash flow, or you're buying an empty building just for repurposing it, that does not have cash flow. And those are specialized areas that I think take specialized knowledge and understanding to be risk-free in going into those kinds of investments.
Fair enough.
So in my discussions with the people that I talk to, there's one word that always comes up that I like to discuss, and that is risk. So we have several types of risk, and we want to measure each of those risks and talk about why Wall Street might have a lower risk or why real estate might have a lower risk. The first one is what is often called market risk, and that's the risk that the asset's going to fluctuate in value. Wall Street certainly fluctuates wildly. We've seen stocks drop 600-800 points, or the indexes drop 600 or 800 points in a day. They can go up 1,000 points in a day. Stocks typically have a much busier fluctuation. Real estate takes a much slower approach to going up and down and leveling off, and generally is going up. It's not often. 2008 was the last big time that we saw a significant drop of greater than 20-30%. Even right now, nationwide, we're only down between 10 and 15%. So I think we can see that come back pretty quickly in the next year or two, and real estate will just keep marching on with that fluctuation being pretty minor. Liquidity risk is the ability to convert an asset to cash. In this one, Wall Street wins because it's quite efficient. You can call your broker today, and in 3 days, they can send you a check and you have your money. Real estate is not quite as efficient. It can take weeks or months for cash to come out of real estate. You can certainly, get a loan. That could take 3 to 4 or 5 weeks to get a loan. You could sell it. That could take 2 or 3 months to close and have the cash in the bank. So liquidity, we want to have lots of cash reserves when we're using real estate with leverage. That's how we maintain our liquidity risk and keep it quite low. Retirement risk is having the ability to have enough assets to fund a retirement goal. And as I talk to people, they've been at Boeing for 40 years, and their 401ks have done well by what you might perceive 800,000, $1 million, $1.2 million in value. But when you realize that you can only pull 4% of that out a year, it can be a challenge. So somebody who's making $100,000 now at Boeing, as soon as they retire with $1 million 401k, their income's going to drop to $40,000 plus what they get from retirement or Social Security. So they actually cut their lifestyle when they retire. I would like to maintain my my lifestyle in retirement or improve it over time. So with real estate being able to return a much higher internal rate of return, we double our money much, much faster. So and I'll show you some numbers here soon of how that doubling makes a significant difference in the end. But having a goal in retirement to fund the lifestyle that you want to live is important. And real estate is one way to build that wealth over time.
Tom, are you going to show folks how to calculate internal rate of return?
I'll discuss it. It's not done easy. We have to use a spreadsheet to do it.
Okay.
So I like to teach the concept of what internal rate of return is, but the mathematics behind it are pretty advanced.
Yeah, and the short version is, if you do have questions on that, reach out to some financial professional, and they can calculate that for you guys. Tom's happy to help. I'm happy to help as well if you need.
Yeah, there are calculators. Excel does it quite well, but you have to understand it conceptually to build the data. So as we continue with risks, there are always asset-specific risks. Any one asset could have a flaw. In Wall Street, you could have management that's not good. You could have fraud that shows up. You could have lawsuits. You could see what Bud Light just went through in the last few months with a misstep in its marketing. Real estate assets also have those same risks. We have to deal with tenants and what they can and can't do to a property. There's always maintenance. The roofs don't last forever. And landlords can be as much a challenge as the tenants can be. If you have landlords that won't invest in their properties and keep, if the neighbor's property starts to look like a slum, that impacts your value and what's happening to your property. Economic risks. The assets vary based on the economic cycle that we're in. Wall Street can be quite volatile. There's daily news. There's geopolitical things that go on. We just saw where there was an uprising in Russia that may have impacted Putin and his ability to lead. The stock market would have reacted instantly to that news. There's sector risks. There could be a problem in the medical sector or the automotive sector or some other, the tech sector, that all the companies in that sector react to that bad news. Real estate is less volatile, but things do change over time. You have the local housing market, what's going on. You could have a natural disaster. Certainly the hurricanes, tornadoes, earthquakes are all things that we would deal with real estate. We have financing risks. It's possible that we're financing our real estate with a line of credit that has a variable rate, and now all of a sudden our payments have gone up 150%. We also have the deterioration of that asset over time. If you don't maintain it, it will decline in value over time. So with economic risks, they're both there, but real estate is certainly less volatile. And the interest rate risk, which is closely aligned with the economic risks, has to do with what happens when the interest rate changes. Wall Street does not use a lot of leverage. So the individual investor at Wall Street did not see a significant problem with interest rates other than how interest rates affected the profits of the companies that they hold. Real estate, certainly, if you're not financing properly with an eye to the future, those interest rates hikes can negatively affect your returns. And we could have a long and ongoing conversation about risks, but there are many, many kinds of risks. And certainly if anybody has a type of risk they'd like to discuss, we could certainly see that. I don't know if anyone has said anything.
I don't see anything in the chat box yet, Tom, so we'll continue on.
We'll just continue on. Okay. Let's talk about the pros and the cons of the different assets. We touched on this a little earlier. With real estate, we have cash flow that comes in every month, usually. We have appreciation that happens over time. It's very hard to predict when and if you'll have appreciation by a particular date, but generally giving years and decades, appreciation happens. You do have control over what happens to the property. You can choose to improve it. You can develop it. You could add, in Seattle, there's a big movement now to have auxiliary dwelling units put into the backyards of homes, and that's adding significant value. They're tangible. You can see it. You can touch it. we can use leverage. So we can certainly borrow 60, 70, 80% of the purchase price and have high leverage on the property to get a greater return on our down payment. Tax benefits, we get to deduct the depreciation and the interest over time. And particularly with the rules that exist today, we can take a lot of upfront depreciation. We pay lower taxes when we sell them, and we have a potential for much higher long-term returns. And I'll show you some math on that. The pros of Wall Street, you can arrange your portfolio so you're getting dividends from your stocks. If you buy growth stocks, you'll have some appreciation over time as well. It has the advantage of liquidity. Cash is available within days. There is diversity, many different sectors, companies, and countries that you can invest in. And they also, if you held them long term, you still pay the lower capital gains taxes on the sale of the stock. But as you can see, the pros of real estate is a bigger list than the pros of Wall Street.
Thank you.
And when I look at the cons, in real estate, you can always get that surprise, unexpected repairs. There are tenant issues. You know, some tenants just have a way of putting holes in your walls and messing up your floors and doing their thing. You have to pay for management costs if you're not going to do it yourself. Again, we have those natural disaster problems that could happen. And the upfront capital to get started in real estate can sometimes be significant. You know, you can buy stocks for $500, but it's hard to buy real estate for $500. But there are ways, creative, and if you're bold enough to go out and ask, you can get into real estate with a much less money than some people perceive.
Well,
Wall
and even
Street,
just the regular loans, guys, and we have 0 down loans to get into real estate, so that helps eliminate that down payment options. And FHA is 3.5%, and conventional as low as 3%, and so there are certainly options to get into real estate with low down. And Tom mentioned this, I just want to kind of embellish on a little bit. Part of the management cost is you need to maintain real estate. So that if you don't maintain it over time and continually keep it up, it's going to deteriorate in value, real value. So it should be noted.
right. The cons of Wall Street, the volatility is large and it occurs almost daily, right? There's TV shows, the financial shows always run the ticker that show you things are up 2%, down 2%. It's just always moving. It's very open to the politics and geopolitical issues that drive it. It seems funny that if there's a pro-Biden conversation today, stocks react a certain way. If there's a pro-Trump conversation today, they go a different direction. If Russia decides to do something, they go another way. One problem with stocks is you have no control over what happens with the company. If a company decides that they're going to sell off a particularly profitable line, you don't have any control over what the company decides to do. You just are at the mercy of the management team. There's poor leverage options in Wall Street. If you're going to buy $100,000 worth of stock, you kind of have to put $100,000 out there. You can use margin, you can get lines of credit, but that is an advanced topic that takes a little bit more conversation. I will show you why there's a lower internal rate of return on Wall Street over time. And particularly when it gets to 401ks and IRAs, we have high fees that we have to pay. And when they quote their returns, those are returns before the fees. So it's not as transparent as you might hope it is. But let's take a look at the cash flow from real estate. Here I have an example of rent versus dividends. So in my first example for real estate, I have a $400,000 house. I'm going to buy it with $100,000 down. I'm going to get a $300,000 mortgage at 6%. So my payment would be $1,799. And I expect to receive $2,500 a month income from my tenant. So I see that I have $30,000. That's to 12 times 2,500. My rent income for the year is $30,000. The $6,000 would be taxes and insurance, maintenance that I have to pay on the property. 12 months of payments would be $21,588. So the net cash flow from this property, which is about $200 a month, equates to a 2.4% cash on cash return on our $100,000. So we use these ratios to see how things are performing. There are a lot of investors that would not touch a 2.4% cash on cash return. But I can show you why in the end, this is still better than anything else you'll buy. The first year depreciation on our asset would total $11,000, and we would have principal pay down on our mortgage of $3,740. That's like putting money in a savings account. You're making the payment to the bank, but part of it is paying down what you owe. We would end up with a tax loss of $54.83, which gives us, if we were paying 25% tax, we would save immediately in the first year $1,371 in tax that we would be paying to the IRS. So in summary, on cash flow, our $100,000 investment created $2,400 cash flow, $3,740 in payoff of our loan, and $1,371 in tax savings. So we actually, after tax, netted $7,523 in cash flow, which brings our actual after-tax cash-on-cash return to 7.53%. That's not a bad number. When we compare that to Wall Street, when I compare that to Wall Street, the average S&P 500 dividend is only 1.66%. There are stocks that pay more, and I'm going to assume in this example that we were able to get a 5% dividend yield from our stocks. That would be at the high end of most dividend stocks. So if we took our same $100,000 and we bought this stock, we would receive $5,000. So our cash on cash return first year is better than real estate at 2.4%. But we'd have to pay tax on the $5,000. So again, we would have a tax rate of 25%. That equates to a tax of $1,250. So we actually only really kept $3,750 in that first year in cash, or a 3.75% benefit. So in this example, real estate beat Wall Street, even though we had a great dividend stock and we had a marginal real estate cash flow.
Let me pause you there and check the chat to see. That's pretty good.
Okay.
Overview you just did, but I still don't see any questions. I do have a kind of a sidebar question that I get occasionally, Tom, and this is a good time maybe to ask it. If someone is a W-2 wage earner and they're making high income, so they're in the 25% tax bracket, and they buy, let's say, one rental property, and they go through that analysis there, and they have a loss at the end of the year, does that loss help offset the taxes on their W-2 income?
If they're only a W-2 income, probably not. So what we try to do is to get them established as a real estate business owner, and certainly try to get that real estate professional designation so those losses are passed through that first year.
Okay.
It's not always possible for high-end W-2 earners, but they don't lose the loss. They just have to wait to be able to deduct the loss.
So then it becomes what's called a loss carry forward that they can use in additional years?
Yep, it's a passive loss carryover. It would be fully deductible in the year of sale no matter what. But yeah, they don't lose it. They just have to wait to have it.
All right. And Joy wants to know, if you hold the stock longer than 1 year, it's considered long-term and the tax rate should be lower than 25%, correct?
Not on dividends. Dividends are ordinary income. So ordinary income tax rates apply. If we sell the stock, then we would have long-term capital gains rates. But in this example, I'm only talking about the income stream from the assets.
All right. She's writing one more follow-up question here. Let's see if we get it in here in time. Gotcha.
Okay, I see that. Okay.
All right. Thanks, Tom.
Okay. Now let's talk about appreciation growth. We have the exact same house, $400,000, $100,000 down, the $300,000 mortgage with the $1,799 payments and the same rental income. In Seattle, our average growth rate over the last 30 years has been 5.4%. So the first year, our property should go up on average. This isn't every year, but an average year would be $21,600. So on our $100,000 down payment, we made 21.6% return on the growth of the asset. When we do that, we will be doubling our $100,000 in 3.5 years. In 10 years, we would have $176,000 of equity in that house, just from the appreciation side. In Wall Street, the average S&P 500 growth rate for 30 years has been 10.7%. So we take our $100,000, we buy into a growth stock, and we would have made $10,700. That would take us 6.82 years. So even though we have an asset that is appreciating high at a faster rate, because we don't have the power of leverage, our total equity after 10 years is significantly lower. So the real estate growth alone is what makes most people create their wealth.
Very good.
That makes sense?
Yeah.
So now here we get to the magic math. This always kind of throws people. This is where we talk about the internal rate of return. And that, as we talked about, is a pretty complex mathematical formula that takes a spreadsheet to figure out. But I'll give you some simple examples. In real estate, we know we made 7.53% cash benefit plus appreciation of 21.6. So when we combine those two numbers, we get 29.13% return on our $100,000. So our 100,000 would double in 2.7 years. And when you look at the equity growth over time, we have a tremendous amount of money after 30 years. And this seems very hard to believe, but John, you and I both know some investors in REITs who started with nothing, and they're 15, 20 years into it and have 50, 60 million in real estate.
We do, and I want to reiterate what Tom said at the very beginning. It takes work to do this, guys. It really does. You got to be on top of it and manage it and all of that. It just doesn't happen.
And this is also assuming that you keep reinvesting your money. You are not living on the cash flow. You're not buying a car with it. You are reinvesting in more and more and more and more real estate with those assets.
Tom, if you're reinvesting it, does it take into account those numbers, the transaction costs of the reinvestment? You
like the purchasing costs?
Yeah.
It doesn't. It's assuming, that at some point you have another 100,000 that you pull out of a house, you can put that down on the second house. 5 years later, you can pull 200,000 out, 100 in each of those houses, and buy two more. Okay. So in a few years, you have 4 houses, then you'd have 8, then you'd have 16. Yeah, okay. You're going to keep reinvesting. Wall Street does the same thing. You have the 3.75% cash benefit from the dividends. You have the 10.7% appreciation. So you can make 14% return on that stock portfolio over time, but it takes 5.14 years to double with this internal rate of return. So even though after 30 years, it sounds good that you might have $5.7 million to retire on, but that pales when you compare it to the 29% return that real estate can produce. So certainly Wall Street is less effort. You put your money in, you just keep buying more as the dividends come in. Real estate's a lot more work, but it creates a lot more wealth.
And I'm guessing the Wall Street numbers don't anticipate the transaction costs of the brokerage you're working with and all of that in those numbers. Is that correct?
So there's, if you get dividends and you go buy more shares of stock with your dividends, you might pay commissions based on your brokerage. I don't have anything in here for sales. We haven't sold anything. Right. We just keep buying and buying and buying, either buying more real estate or buying more Wall Street assets.
Yeah. Well, the point that I'm making here, guys, is it costs money to buy too. There's going to be transaction fees with Wall Street, and there'll be certainly transaction fees when you're buying real estate, but both of them have that. And certainly the numbers are going to be impacted somewhat, but the difference in those numbers is still tremendous.
It is. And most people take their gains from real estate. They might make $100,000 5 years later, but then they take the money and they go do something with it other than buy another house. Yes. The real secret is to take that 100,000 and roll it and roll it and roll it. We call that velocity of money. So every time you take money out of your pot, that reduces your rate of return. So now I want to show you an example of what happens if instead of a 6% interest rate, I did the exact same analysis with an 8% rate today on a real estate loan.
Oh,
So
good.
we have the same house, same rent, same costs. I don't know why my operating costs went down, but our payment certainly went way up. We have a much higher payment. We went from $1,700 to $2,200. Now we're negative cash flow, $100 a month. We're going to take the same depreciation. We're going to be paying down less principal. That 8% loan is going to have more interest in the payment and less principal pay down. We will have a greater tax loss, which saves us first year taxes. So when we net everything together, even though it was a negative $100 a month to hold the house, we paid off $2,500 of our mortgage. We have tax savings of $2,500. We actually have a 3.88% return on our $100,000 down payment. In Wall Street, it's not affected by the interest rates. So it's the exact same yield. We have the 5% dividend. We pay taxes on that dividend. We get a 3.75% first year cash benefit. So even with a much higher interest rate, real estate still outperformed the stock market in cash flow.
Significant.
Does that make
So,
sense?
Tom, yeah, it actually makes sense. And it's a good time for Joy's second question here. You probably see it there. Say if you have $500,000 cash on hand, is it better to pay all cash, buy one property for $500,000, or get two properties of $500,000 each and pay down 50% for each one and have a mortgage of $500,000 total? What's better, the internal rate of return?
So I'll give you so the basic math would say the less you invest, the greater your internal rate of return. However, you can't buy houses for nothing down and have a risk-free investment. So the math that I would use on this is how much is the rent coming in and what is a safe level of debt to carry on that property. So you might put $200,000 down on two houses and get a $300,000 mortgage on each one and put $100,000 in reserves for the what ifs. And then as those houses grow over time, refinance, pull some of that fresh new equity out and go buy a third house, a fourth house, a fifth house. When we use leverage, we want to make sure we have cash reserves on the sidelines. That's how we mitigate the risk of using debt. And I know there's a lot of people who teach and coach in cultures that believe that debt is a bad thing. But debt is really the only way to make real estate super perform. It's learning how to manage debt properly that matters.
Here's sidebar here, guys. We have another webinar we did with Tom. I bet this was probably over a year old, where Tom talks about optimum debt. Because you can have too much debt and it's a problem, and you have too little debt and you don't get the optimum performance on your real estate. So we'll probably put a link on our YouTube channel in here. And if you want to see the optimum debts webinar that Tom did with us, you can click on that and it'll be there. And guys in the audience here, if you want to see that, just send an email to Marion or myself and we'll get it over to you. Thanks, Tom.
Very good. So let me give you, this is the second slide of my 8% return. So even over time, at an 8% mortgage rate, we would not have as much money as we would have had at 6%, but we still beat Wall Street hands down. We'd have a $90 million equity versus a $5.7 million equity. So interest rates, although they appear important, they are less important to the end result of your portfolio than you think. You just manage debt properly and the interest rate does not become as big a problem.
You still got to be able to make the cash flow, guys. That's pretty obvious. I know. I just want to point it out, though. That negative $100 a month may be kind of tough for some folks, but if you can do it, this is the result.
Well, I certainly don't advocate that we buy properties with negative cash flow. In an example like that, we might have put $200,000 down on our $400,000 house at 8%. And then when the rates dropped, we could refinance and pull cash out to buy the second house and the third house. There's some math involved in what's the optimum debt. And it really is tied to the cash flow from the property. So with that, this is my information. So people can reach out to me. I have a website, tomhowell.com, where people can book a Zoom call with me if they want on a calendar. And other than that, I am notorious for being hard to get by phone, but I'm happy to schedule the Zoom calls a day or two in advance and be available for those, and I can answer people's questions that way. I am quite busy with the real estate world right now. I think this is the best time to be out there making deals. People are afraid of what's happening, and when there's fear, there's an ability to negotiate some things. So I would encourage you to get out there and just sort of muck around and negotiate with some sellers and see what they're willing to do. I happen to be working today with a woman who's an executor of an estate. She's so fed up in dealing with lawyers and accountants and family members and everything. She virtually wants to give the house away. It's $1 million plus house, and she's like, I'm fed up with it. If someone just paid me half of what it's worth, I'd take it. I heard that, and I'm standing in line. So
sounds like an opportunity to me.
it is. So it's out there. People are willing to deal for whatever their personal individual reasons are. So it's all about building that portfolio to a level in which it'll fund the retirement of your dreams.
There you go. Thanks, Tom. Is that the end of the
Okay.
slides? This right here, Tom? Is that right?
That's the end of the slides. I can
You can keep it up there for a moment. I
unshare
do want to ask you a
somehow?
couple of questions and notes. So I've worked with Tom for a long time. I can certainly support his assertion. He's impossible to get a hold of on the phone because he's a really busy guy. So you just have to adapt and send Tom a text and set up a time, and he'll be there. He loves the Zoom calls. He's a great mentor. And there are a lot of people at the REAPS organization. If you don't know REAPS, it's the Real Estate Association of Puget Sound. And we'll try to get a link on our YouTube page for that underneath this. So if you want to go there, it's a bunch of real estate investors, and it's a very large organization in Seattle or Bellevue. Actually, it meets now with some ancillary groups, one of them being the Everett Group, and a number of others as well. Good place to get plugged into if you want to learn more about investing in real estate. Tom's a speaker there. He's there a lot. And getting back to my point, he mentors a lot of people there. So if you're interested in getting mentored, just reach out to him in the right manner, and you can make that happen. And Tom, I saw just recently, I don't know if it was on that last slide, that you have a new website with your properties on it. Do you want to talk about that at all?
Sure. So I have an investment company that I'm generally buying and holding. My construction people like to say I don't flip houses, I collect them, because I tend not to sell them. But I'm now doing a little more wholesaling because we're out marketing and finding people to talk to. And I find houses that are good deals, but they're not right for me at this moment. So I put them out on a website called Buy from Revest, where I post what houses are available, and I want to send an email out to my kind of inner circle and see if they want to have first choice at buying some of these pre-negotiated real estate transactions.
All right.
I love seller financing. I love the creative deals. So some of my deals are not, straight up 25% down, get a mortgage kind of deals. They have some moving pieces to them, but we make the math work better.
There you go. Tom is an outside the box thinker, guys. That's why people love working with him, because sometimes you need outside the box solutions for a real estate situation. That works. I see a couple of great info. Thanks, Tom, for that. Thank you, Teresa, for that. Thanks, Marcia. If you don't buy that lady's property, put me in line. I like it. Tom Howell, Revest Strategies. Thanks for joining us today. We appreciate it always, Tom.
Very good. Thank you.
All right, guys. I don't see any other questions, so I guess let's see you all another time. Thanks for joining our webinar.
Thank you. Bye-bye.
Thanks, Tom. See ya.